Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly review for the week ending February 24th, 2023. So let's start with a look at this week's markets at the close on a Thursday. So this is the picture after 4 days. Now it's Friday morning, markets are not open yet, but the futures are sliding because of, you guessed it, inflation again. So we had the inflation numbers in the US this morning, and we've seen this trend over the last few weeks of economic surprises being higher, inflationary pressures being more sticky. Last week we had the CPI inflation index in the US. This morning we got the PCE, so just another index for inflation, but this is the one that's favored by the Fed. This is the one that they quote, so it's a very important one, and it was stronger year over year than expected, stronger month over month than expected, and the last few months were revised higher. So now the odds that the Fed reaches its inflation target by the end of the year just took a hit, and the markets were already suffering from that over the last few days, and the market is integrating the information that likely more rate hikes are coming. And as of this morning, based on the reaction in the markets, we see that markets are pricing rate hikes in the US in March, in May, and in June. So this is what's priced into the market. So markets are adjusting to this information, and if rates are higher for longer, that means that less liquidity in there's less liquidity in the markets, and that should be detrimental to equities. So this is what we're seeing getting priced here. So we still have decent returns year to date, but there's a lot of fragility in the markets, and we remain defensive in our positioning. That hasn't changed, even though we underperformed since the beginning of the year for sure, based on this strong rebound that you see on the right. But we think that we are going to be right, and volatility will make a comeback. Oil lower, price of, the USD was stronger on the week, so that pushed oil lower. The Canadian dollar lower, the euro lower, and the price of gold also same thing, down 1% on the week. So just discussed the inflation numbers in the US. Inflation in Canada was the highlight on our side of the border this week. And as you can see on the chart here, year over year, it continues to slide lower because the base effects, so the months which we are comparing, plays an important role on the year-over-year numbers here. So we used to compare December to December last month. Now we compare January to January, and inflation was very strong in January 2022, meaning that when we compare to a higher base, that pushes the year-over-year numbers lower. So it's kind of hiding the fact that, as you can see on the right, month-over-month inflation is actually accelerating right now, or at least it's stronger than what would be comfortable. So that this is the story that's going on. So it's very likely that we continue to see the headline numbers that are quoted in the media, the year over year, continue to move lower until this summer, and then after that start to pick up again. So Bank of Canada, based on that, also we continue to believe that they will be forced to hike a few more times in 2023. How many, it's not sure, but in March, I think it's very unlikely that we have a hike because they signaled the pause last meeting. So likely they are going to be staying in a pause, but point strongly towards April being a live meeting so that they could continue to hike and highlight the fact that the labor market is stronger than expected, wage pressure remains, and inflation has been more stubborn than expected. But the good news, so that means the economy is stronger than expected, it's more resilient. So the good news is that recession odds need to be revised lower too. So we used to say that there was high odds of a shallow recession. Now it's low odds of a shallow recession, so it's not something that's very scary. And on the left, this is what you see here, the consensus of economists surveyed by Bloomberg. On the bottom left, you see that, in the US, in Canada, and in Europe, but all three GDP growth numbers are being revised higher. These are the expectations of economists. On the right, 2024, no change yet, but we have to be cognizant that if the economy is stronger in 2023, less odds of a recession, but central banks tightening some more, that means that likely 2024 is going to be revised lower down the road. So the risks of a recession, maybe they're just delayed, but it's not like we just avoided a big bullet and everything's fine. It's just that inflation should be an issue this year, and growth maybe in 2024 is when we could see a recession. Now, let's see if as the year goes on, if we still think that's the case, if we still think it's going to be a shallow one or a more profound one. Let's see. But right now, we're moving the odds of a recession lower and the odds of more rate hikes higher. So maybe just talking about strategy in markets here briefly. So you have stocks that are currently expensive. Interest rates are at a 12-year high. So on the left, you have the forward PE ratio, the price earning ratio for the S&P 500. So if you look at the chart on the left, there was this bubble during COVID because rates were very low, lots of liquidity, so markets were expensive. We deflated that bubble, but now we're starting to pick back up. And if you look at the level that we're at now on the forward PE metric, we're at the highest level since the outcome of the dot-com bubble, which started to burst in 2000. So markets are expensive for equities now. At least the S&P 500 is very expensive. Canada is a different story. On the right, you have the 10-year rate in the US, which is at the highest level since pretty much the great financial crisis. So that means that bonds are more attractive, which leads us to the next chart. This is the equity risk premium. So you compare how expensive stocks are versus how expensive bonds are. And just when this chart here, when the line is low, that means that equities are expensive versus bonds. And when the line is higher in the chart, that means that equities are cheap versus bonds. So equities were cheap versus bonds for most of the last decade because of quantitative easing. And now, as you can see, equities have become the most expensive versus bonds since 2007. So that's 15, 16 years now. So that's why we favor a defensive position still. We think the odds long term, we're long-term investors, we think that there's more gain to be had from holding bonds than equities at the margin, of course. So we remain overweight fixed income, underweight equities, but mostly through US equities as of now. What to watch next week in Canada? We'll have GDP. Last month we had 0.1% positive in November. We'll have the S&P Global Manufacturing PMI. Last month we had the 51 in January, so still holding strong. Anything above 50 means that there's still some growth. In the US, we'll have the Conference Board Consumer Confidence Index, should be rebounding from low levels. ISM Manufacturing Index, ISM Services Index may be diverging, but showing how split the US economy is. Services strong, manufacturing is weak. So that wraps it up for the week. ia.ca/economy. You can subscribe to the newsletter, you can follow the podcast, and you can follow us on social media. So always a pleasure to serve you, and I'll be back again next week.